Well, it's the first days of the Trump presidency, and one thing is clear. We don't know when we'll see Trump tariffs, but it appears we do know whether. Today, we'll do a blitz through tariffs, trade, and Trump, what it's all going to mean for Albertans, and one idea so bad it makes Trevor Tombe want to curl up into a ball and cry at the stupidity of it. A direct quote. Yes, today we're joined to put some facts to rhetoric by renowned national economist Trevor Tombe. Trevor is a virtuoso of the chart. He's a professor at the University of Calgary, and he's the director of Fiscal and Economic Policy at the School of Public Policy. And if you've been wondering what exactly is a tariff and how does it work, we ask him that too. We're also joined by guest host and director of policy and economics at the Business Council of Alberta, Alicia Planincic. You can read both Trevor and Alicia's work weekly in the Hub. I'm Scott Crockatt. This is an Alberta Better podcast from the Business Council of Alberta. You're listening to The Brief. So, Trevor, Trump's inauguration is officially behind us, and we officially have a new president in the United States. And we did not see any tariffs on day one, as many people had feared, me included. I'd love to hear kind of your thoughts on what do you expect the short term and the long term of the Canada-U.S. relationship to look like now under this new president?
Well, I think what we learned on day one was to not expect too much, that unpredictability is going to be the name of the game. We saw that with the announcement that there would be no tariffs immediately on day one, and you saw markets react and the Canadian dollar shoot up by a little over a cent instantly. And then just a couple hours later, clarified that, oh no, tariffs may appear February 1st and the dollar crashing back down to where it began. And then some other uncertainty there, like the actual wording of the executive order with respect to trade and exploring remedies to address trade imbalances, has April 1 as a date when some of those processes will be concluded. So I don't even know whether February 1 is going to be the date when tariffs occur. Could be, might not be. And I think this is just going to be how things are for the next 4 years, which is really unfortunate for the Canadian economy. The massive uncertainty that we face is going to be a huge drag on business investment. If you have in mind a large-scale new project or expansion or looking to purchase new equipment and so on, you might prudently pause, maybe wait until some of this uncertainty is resolved. And while it's tricky to measure, it does look like uncertainty levels, using kind of the best index we have of this, has shot up in December to the second highest recorded level, behind only early 2020, which was not a good time.
Pretty uncertain time, yeah.
Yeah. What's January going to show? We're probably going to break the COVID record level of uncertainty. And that's something where we're going to see a lot of ups and downs. And we saw that even just over a matter of hours on day one.
Yeah, it's wild how often we need to check our social feeds and kind of refresh before going into an interview because we don't know what's changed. You know, a lot of the reason for why we're having these conversations around trade and trade barriers really comes back to Trump's view of trade as having winners and losers. And one of his sort of flippant, but maybe not comments was that the U.S. is losing $200 billion and more to Canada on trade every year. Can you talk a little bit more about this number, what it means? Is it correct? And is it bad?
The president has for a very long time, even prior to his more recent political career, like even all the way back to the 1980s, complaining about trade with Japan, taking out full-page ads about how America was being taken advantage of, always coming back to this idea that it's the trade balance that matters, that how an economy gains from trade is through a trade surplus. And anytime you don't have one, you're losing. And so for the president to refer to this trade imbalance that they do have with Canada as a subsidy is kind of what he means there, a $200 billion subsidy. Now, whether the trade balance is $200 billion or not kind of depends on what you mean. There's different ways of measuring trade. Canada and the United States also both measure it differently, so the statistics are a little bit different. Do you include services along with goods? And so there's, one could quibble with the numbers, but yeah, the trade balance with the states is that Canada runs a surplus, the U.S. runs a deficit. But you dig into that a little bit, and it's basically, depending on how you measure it, either mostly or even entirely due to oil and gas. This is not something where it's a subsidy in the sense that, they're buying a commodity that has a price determined by a global market, and the value of the oil that buyers in the States are purchasing from us exceeds the price that they pay. That's why they bought it. It's a free, voluntary market where these transactions are of mutual benefit. And that's really what trade is all about. It's not about the overall trade balance. But my view here is to really emphasize that the balance of payments between two economies goes beyond just trade. There are also massive financial flows that are, for the most part, one way. I mean, there's flows going in both directions, but the financial outflows from Canada to the States, it's on the order of about $400 billion last year. And so on net, Canada has a balance of payments deficit with the States. They get a lot more inflows from our financial investments than the trade balance would suggest. Now, the two are tightly connected for reasons that I don't know if we want to unpack here or not, but we're investing more in the United States than we are here in Canada. Like, these flows matter. These investments boost the American economy. Maybe we in Canada should be thinking about improving the investment environment, having some of those capital flows go our direction, and that might raise the value of the Canadian dollar, and that might shrink the trade imbalance with the States. And so I think we need a bigger picture than just looking at the trade balance that the president always kind of narrows in on.
Let's zoom in on what you were talking about there, the sort of investment imbalance. Bring it down to the ground level for us. What are some examples of what that might look like in the States? Why are we sending more money to the United States, and for what kinds of things?
Well, capital is mobile, and investors will rightly be thinking about where the returns are highest. Canada's had some challenges in recent years economically, lagging productivity growth, even actually negative productivity growth in many areas. Depending on the sectors, you might have less competitive tax treatment than what you might find in the United States, a little bit more entrepreneurial, dynamic sectors in certain areas. Canada's got an incredible amount of strength in lots of areas as well. But for the most part, the U.S. economy has performed better, I think it's fair to say, than the Canadian economy. And we're seeing a widening divergence between the strength of the U.S. economy and ours. And that just naturally is going to draw investment towards that more dynamic economy where the returns might be higher. What that tends to do with an outflow of capital from Canada is shrink the value of the Canadian dollar. If you have investors here that want to shift into the United States, they're going to be supplying Canadian dollars to the market to purchase American dollars, and that'll shrink the overall value of the Canadian dollar. And that just makes our exports from the U.S. perspective cheaper, so they'll maybe tend to buy more of them. And from our perspective, it makes imports more expensive, so we'll maybe buy less of it. And that's a contributing factor, perhaps an important one, to the trade balance. And so if we think about ways of improving the investment environment in Canada, improving the regulatory environment, improving tax competitiveness, and a long list of things we could think about, then those capital flows might, the margin at least, shift back towards Canada, raising the value of the dollar, and that would have implications for the trade balance.
So you raise a lot of points that I think complicate Trump's view of trade, far beyond those headlines that we see. If you had to, though, think about what he's really looking for in trade between the U.S. and Canada over the next few months, if you had to guess, what do you think that winning would really look like to him? Would it be a trade surplus when it comes to goods? Would it be something else? Will he learn his lesson and realize that trade is mutually beneficial and economists can all sleep soundly again at night? Or what's going to happen here?
Someone just needs to roll a whiteboard into the Oval Office there with a Sharpie to illustrate gains from trade. It doesn't come from the trade balance.
I call that the better chart problem, where some of us are guilty of saying, if we could only produce a better chart and show it to them, they'd change their mind.
So I love a good chart, but I don't think that's what's going to win the day in this case. And I certainly don't want to presume that I know anything about what might be truly behind the president's motivations on this file. Given how frequently for decades he has focused on trade balances as an indicator for whether the U.S. is benefiting from trade, I'd put a lot of weight in that as something where if we could move the needle, and I don't mean implementing, exchange rate controls or, ways to really force investment flows one way or the other, or to artificially change the trade balance. But if we could implement policies that would naturally lead to a change in the trade balance, like shrinking the size of the U.S. deficit from their perspective, that might be good. And if we could flip it to a surplus, again, through policies that are worth doing in their own right, that might be good too. Really just take what is perhaps the dominant issue for the president off the table. The relationship that they have with Canada is especially recently touched on many other issues: border security, migration, drug smuggling. And that's something that the federal government in Canada, to its credit, moved very quickly on with $1.3 billion in the fall economic statement. And I'm not sure if that's enough or whether it's structured in the right way. I'll leave that to others. But that was, I think, good to see, taking that issue off the table. If it's a genuine issue where we should do better, great, we should do better. But even if it's not, we should take the issue off the table by leaning into it and just showcasing how much we're doing with it. But the other issue that would be a challenge for Canada's military spending.
Mm-hmm.
That might be another area where, we have made international commitments to get to 2%, and so we probably should. But that would require considerable financial investments from the federal government, at a time where federal finances are strained as well. So some tough trade-offs that the government would need to be made, but probably should. And if we could address trade balance through productive means, take border security off the table, improve military spending, and make adjustments to the free trade agreement itself. All agreements should evolve over time, but maybe that means more market access in dairy, what have you, which would be, as an aside, would be a great thing for Canadian consumers.
Yeah, all of our dairy costs.
All in, that might be hopefully where we land, where we ourselves make progress on areas that we should probably move on anyway, and are also aligned with the interests of the U.S.
Trevor, if we can go back to square one on something for a moment, you are in fact a university professor. So if I could ask you to be a university professor for a minute, for the benefit of our audience and me too, let's go back to the basics. What's a tariff and how does it work? We're talking a lot about this all the time. Let's go through that.
Tariffs are just taxes that we name differently because they apply on imports. They're just taxes on imports. So we don't actually ever need to use the word tariff. It's just we're levying a tax on things you buy from abroad. That's a tariff, full stop. Now, when we're thinking about tariffs levied by large countries, then it gets a little interesting because listeners might recall from their first year economics class, which was almost surely their
Which
best.
we all do, of course.
I think mine was Peter Tracy at the University of Calgary.
Very, very solid instructor. So you got there. But taxes, who pays them economically is sometimes different than who they're levied on. That's because prices and wages and so on change in response to taxes in a way that can shift the burden. And when a large country levies a tariff, sometimes we see that show up as producers abroad taking a haircut on the price that they charge. And so Canada-U.S., if they levy a tariff on us, I think you'd find many Canadian businesses lowering the price they charge to U.S. buyers. That's effectively shifting the burden of the tariff onto Canadian sellers. When a small country levies a tariff, though, it's really hard to shift the burden of that tax onto the producer because they have so many other opportunities. And for most items, Canada is small relative to total U.S. production of most things. So when we levy a tax on imports, that's probably going to fall, for the most part, on Canadians. Whereas if the U.S. levies a tax on their imports, most of it probably lands on Americans, but some of it is shifted to producers in Canada. And so the economic consequences of a trade war between us, probably bigger in Canada, bigger in the small country than in the large.
Well, let's speak of those consequences. You had a recent piece in the Hub where you highlighted that 2.4 million Canadian jobs are exposed to U.S. tariffs. Tell us a little bit more about that. So what industries and jobs are most at stake, and where might you anticipate the most significant job losses? The scenario every Canadian is concerned about when they think about these things.
Yeah, great question. So regardless of who pays the tariff, like if it's shifted onto producers here with a lower price, well, that's less revenue to producers here. That might mean that they need to scale back operations, letting staff go, unfortunately, in lots of different areas. And yeah, the Statistics Canada data here, it does come out with a little bit of a lag. So these are 2019 numbers, but it gives us a good sense of scale. Yeah, about 2.4 million jobs are exposed to these tariffs. And that's about 13% of all Alberta jobs. 13% also are tied with Ontario in terms of the highest level of exposure. So there's a lot of jobs there at risk. But even if the tariffs are borne by American consumers, over time, they might demand less from Canadians. So you would have a lower quantity sold to those buyers in the States. So either way, there's going to be economic costs on producers here. And where they're probably largest is, well, let me go down like the top sectors where the jobs exposed are.
Great, let's do it.
Oil and gas tops the list. There's about 230,000 jobs connected to oil and gas exports to the U.S. A tariff does not mean that 230,000 people would lose their job if 25% tariff is enacted even on oil and gas. Not at all. In the short term, you might see some disruptions, maybe changes in overtime, maybe gradually then firms might scale back operations, so things would take time to mount. At the very least, you'd have a lot more uncertainty for people in those positions. The second highest sector for jobs connected to exports to the US is professional, scientific, and technical services at about 170,000. And that's tied with wholesale trade. So oil and gas, it is pretty clearly in that number one spot in terms of jobs created due to its exports to the United States. Motor vehicles, gets a lot of attention in Canada. Of course, a very important sector in Ontario and historically an important sector for Canada-U.S. trade. The number of jobs in that sector tied to exports to the U.S. is about 80,000. So about a third of what we get in oil and gas. And I don't want to belittle the experience of anyone employed in any particular sector. Any job loss in any sector is going to be painful for those individuals, but the sectors that account for the most, it's oil and gas in that number one spot. And then also things that we tend not to think much about. There's also a lot of jobs in sectors that facilitate trade rather than actually produce goods and services. Truck transportation, big one. That's a sector where, at least in the StatCan data, there's about 90,000 jobs exposed to U.S. tariffs. Just because if we're shipping a smaller quantity of goods, then you're going to have smaller demand for truck drivers. And so big job losses there as well. So we should keep that in mind.
So if you had to say the most kind of immediate, obvious impact to Albertans at large, let's say, so not necessarily in any particular sector, of the first couple of months, how would we know we're in a trade war without knowing we're in a trade war? What are the things that we would see and notice around us?
Well, great question. So we would certainly see a lot on the news in terms of commentary to this. The government of Alberta is probably exposed to the greatest initial implication of a tariff, if it is truly across the board and does actually apply to oil and gas. And assuming that a meaningful share of that tariff is borne by producers here in the form of a lower price that they receive for their oil. And I don't know if that's the case or not. Some mixture of drivers in the Midwest paying more and producers here receiving less, some combination of that. But that would immediately mean less revenue to the government of Alberta. And they would see that right away. Consumers, the biggest immediate effect might be because the dollar would fall, potentially pretty significantly. It's really tough to say how much, but what we saw on day one, just news that tariffs weren't coming. You saw an immediate 1 cent change. And then news that, they might come February 1st, an immediate 1 cent drop. And all of these are just, probabilistic changes. If we actually see across the board 25% tariffs on everything, you would see the dollar fall a lot more than 1 cent.
And just the sort of,
I don't know how much, but several.
Yeah.
And what that would do is make imports more expensive. And if you're, a Canadian with, a purchase coming up, durable goods are something that we import a good share of here in the winter months. Fruits and vegetables are something we import a lot of. And if the dollar falls by a lot, suddenly you might see those goods rise in price. And so that might be the first thing that most Canadians see as a consequence of the U.S. tariffs. And then if Canadians retaliate, it depends on what. And it looks like, although details we don't know, and sensibly we don't know details, but it looks like they'll roll out at first with tariffs on largely consumer goods, things like Florida orange juice I've seen reported. And so you would see the price of those
whiskeys
items.
and bourbons from certain areas, right?
Kentucky bourbon, that's right. That's right. You'd see the price of those items rise by the amount of the tariff. And then in terms of job losses or disruptions in business activity, that would take a little bit of time to really work its way through. And I think how disruptive things would be would depend on indications around how long the tariffs will be in place for.
Right.
That's really tough to know. The last time we went through this with Nixon in 71, we didn't retaliate, and those tariffs lasted for 4 months. And the economic consequences were, minimized because of that. Whether that's the case this time around, tough to say. Especially if the U.S. is looking to raise revenue to cut income taxes and becomes a permanent feature of the U.S. revenue system.
Right.
I don't know.
So a big question for you then. You've talked about retaliation, but then you mentioned maybe not. If you were to give the government a recommendation on what to do, let's say February 1st, we were to see that across the board tariff, what would you like to see from the government of Canada?
So the desire to retaliate is something I understand. Like it feels good. I think that's
Apparently
where
a lot
most
of Canadians
that's
do,
where most
because
Canadians
Colleen is
are
quite
probably
supportive.
at.
Yeah.
But economically, it's really hard to see how any tariff we put on almost anything would lead to meaningful economic consequences in the United States. And the whole point of retaliation is to try and change the behavior of the US administration. If they levy tariffs on us, our goal is for them to remove those tariffs on us. There's one class of retaliations where it's on things like Kentucky bourbon or Florida orange juice. And maybe you levy those in order to facilitate a communication strategy or marketing in the US or something to maybe
Sure.
try and change public opinion.
Harley Davidson motorcycles, I've heard of the same conversation. Yeah, sure.
That might lend themselves to a marketing campaign rather than us actually thinking that we're, incurring costs on the US. This would be Canadian consumers bearing the burden of those tariffs. And if we think we could move the dial on US public opinion, maybe it's a cost worth paying, and I'll leave that to others to figure that out. But if it's economic retaliation, I don't think we can do that very effectively. In fact, even in areas where some have talked about restricting oil and gas exports or taxing oil and gas export, that by far is the number one item generating the most value added and accounts for the most jobs in Canada. And so it's hard to see why that's a good idea economically for us to do. But my colleague here, Alicia Young, a political science professor here at the University of Calgary, noted in a recent article that she wrote that it would also provide cover to the US administration for potentially higher prices that they'd experience from their tariffs. The president would be able to say easily, high gas prices, that's not the tariffs.
That's Canada.
That's Canada's fault. And it might completely backfire. So I'd be very cautious with those kind of measures. So I tend to think that symbolic retaliation, maybe. Economic retaliation, it's unlikely to change the US behavior. So we should focus on things that will, which is things related to border security, things related maybe to military spending, trying to be clever about ways of affecting the trade balance over time. And, that's not a short-term win, not at all. It would, if we take measures to improve the investment environment in Canada, to improve our productivity and growth and attract capital inflow from abroad and raise the value of the dollar that we talked about before, that'd take years. Think about how long we've had this uncertain trading relationship with the States now. It's nearly 10 years of this. And I think we ought to be thinking more about the long term to have a more secure and stable and predictable and certain relationship with the US and to steer clear of these tit-for-tat retaliations that would largely just hurt Canadians at a time that we can least afford it.
Here, there may be no immediate silver bullets that can solve this sort of a problem, and we may have to look longer term. And I think you began to talk about one of the things that it's occupying a lot of headlines, at least as a short-term option that people think could move a needle of sorts. And that's the nuclear option, as you've described it, of some sort of total embargo potentially on energy like oil and gas and maybe even power exports. And I'm going to pull a quote from you from something that Tristan Hooper wrote recently. You said one thing that would happen if that took place was you would curl up in a ball crying at the stupidity of all of this. So tell me, Trevor, you're normally a pretty measured guy. That's a pretty fun quote, but also a pretty strong one. Why do you say that? What would be the effects of this nuclear option, which, to be clear, the Business Council has been very much on the record. We and our members do not support at all. But tell us it from your perspective.
It is the single largest value that we derive from our exports is oil and gas. In 2022, most recent year, we generated about $150 billion in income to Canadian businesses and workers just of our exports of oil and gas to the US. By far the number one sector. The second largest source of value added from exports to the US was wholesale trade at $25 billion. Like the gap is so wide that if we're thinking that we're going to retaliate against the US by cutting off the single largest, most valuable export that we send to the US, it is not just shooting ourselves in the foot, but it's shooting ourselves in both feet and other body parts as well at the same time, thinking that we're actually going to move the needle in the U.S. when it, as we just kind of talked about before, might provide the U.S. administration cover from the consequences of its own tariff choices. And maybe if we cut off electricity or oil and gas, we'd maybe cause a brownout or two for a couple of days, but they'd respond. Right? They'd be able to rejig some of their power systems or bring other generators online and get through it and be fine. Maybe some refineries might run dry for a bit, but retool, gas prices being high there, they'd maybe tap into their strategic reserve and they'd get through it. And then what would they do following this? Well, they would almost surely change policy, change infrastructure, retool refineries, change some of their imports from elsewhere to permanently lower their reliance on Canadian oil and gas. And so it would be something that would have incredibly massive short-term consequences for Canada and a permanent long-term reduction in our ability to sell this incredibly valuable resource to them well into the future. And so I find it a really scary prospect. No one is thinking that we should be shutting down auto exports to the U.S. or blocking all, machinery and equipment or parts or banning Canadian professionals from supplying their services to clients in the United States. Like all of those are bad ideas too. And this notion of, and we hear it a lot recently, that all options are on the table. And it sounds good, but maybe bad ideas shouldn't be on the table.
That was a great quote. So along the same lines, we didn't hear from President Trump on tariffs, but we did hear yesterday this announcement of an energy emergency, the gist of which I think I can characterize with 3 words, which was drill, baby, drill, which I believe was actually said from the president's mouth.
I think that's a policy idea.
Yeah. What do you make of this, and what do you think it means for Canada and that relationship?
Yeah, that's a really great question. And it's an area that's definitely worth watching because no president has ever declared what's called this national energy emergency before. This is a power that I'm not a detail in all the implications of it, but it would allow for certain environmental regulations to be suspended. We have had regional energy emergencies declared. Jimmy Carter is one president that did this. And so it might allow for more extraction and development activity for oil and gas in the United States. How widely this is applied or how much production this is actually able to facilitate being brought on stream, I don't know. I'm not sure that it should be seen as something that itself is negative for Canada. It might lead to more energy infrastructure that might actually help Canada or provide more flexibility on the ability to ship barrels. I think that might be in part why Enbridge's stock has done quite well in recent days, just to illustrate, an example of that. But I think it's too early to know because we've never seen a president use this before. And so there's not a lot of experience in terms of what the implications of it is, but certainly quite potentially interesting. And I guess we'll see if it's more symbolic than anything else.
Trevor, this has been fascinating. Maybe one last question for you to sort of zoom out beyond the conversation of this week and of tariffs. We've already heard companies talking about how a kind of more attractive regulatory and tax environment in general in the United States under this administration could lure more of their capital deployment south of the border, especially if they're a company that has operations on both sides of it. How concerned about that do you think we should be?
I do think we should be very concerned about this. And I think we should be concerned about this regardless of what the U.S. election outcome was. We have seen for now many years that the Canadian-U.S. economies have largely decoupled from one another, which is like a new development. If we look over the 20 years between 1995 and 2015, a period that featured energy booms and busts, dot-com bubble, the financial crisis, September 11th, and more, the two economies moving in lockstep. GDP per capita growth in Canada and the US over those 20 years, basically identical. Since that time, so over the last 9 years, almost a decade since, Canada's been pretty stagnant, not literally zero, but close to it in terms of real GDP growth, while the U.S. just continues on its previous trend. And had Canada just kept up with the States, like followed the same pattern as what existed for the previous 2 decades, our economy would be about 20% larger than it is. So it's like a foregone economic opportunity here of $600 billion a year. That we're
Is it
just
fair to think about that for
generating.
the average Canadian as like you could be 20% better off, roughly speaking?
Yeah, GDP per capita is a great way to kind of proxy real incomes, like what's our standard of living. And it depends on how you measure individual income and whether it tracks with GDP. So if you just look at average wages, it doesn't perfectly track GDP per capita. But if you look at hourly compensation in total, like you include benefits and other things in there and payments that you receive from employer that are not tied to your hourly wage, then they track them really closely. So labor compensation on average per hour moves with GDP per capita. And so, yeah, living standards are literally about 20% lower than they would have been had we just kept pace with the United States. And most of that comes down to productivity. And a lot of that, most of our labor productivity growth is tied to business investment. Since 2000, about 90% of our labor productivity growth is from business investment. Just more machinery, more equipment, more technology, more everything at the disposal of workers means we can produce more per hour, more productive. Higher compensation comes with that.
Great.
And we're just not seeing that to the same extent in Canada. So a huge missed opportunity that should really animate governments to think about ways of improving. And there's a long list of things. So you mentioned tax competitiveness, regulatory certainty and predictability. And that doesn't mean we need to slash regulations everywhere. If we want to have stringent regulations to achieve a particular objective, great. Stringent, predictable, timely, stable regulations, companies will respond to. But when regulations are changing all the time or subject to uncertainties or political judgment calls along the way with timelines that are hard to predict, that's a problem. So we need to do a better job there. And then, I like to mention interprovincial trade costs anytime I can, because Canada is very decentralized, right? And we look to the federal government a lot. And I think we forget that provinces are also very, very important in terms of ensuring that the economic union in Canada is strong. And provinces have kind of dropped the ball there too. So hopefully this is a moment where all governments at all orders can think about ways of strengthening the economy, for its own sake, but also so that we can be more resilient in the face of an uncertain world.
We think this should be a bit of a wake-up call on those things that you've brought forward, and perhaps that can be some of the silver lining that comes along with these discussions we're having at the moment in pretty uncertain times. Trevor, we just want to say thanks very much for joining us today.
My pleasure. Thanks for having me on.
Thank you for joining us for this episode of The Brief, an Alberta Better podcast series. This podcast is a production of the Business Council of Alberta, and you can learn more about us at businesscouncilab.com. We'd also love to connect with you on social media. Hit us up on any of the major social media platforms and check out the latest of our work. And finally, don't forget to subscribe and tell someone else about the show. Your support means the world to us and lets us keep making podcasts. Alberta Better is available on Apple Podcast, Spotify, or wherever else you listen to podcasts.